This podcast is sponsored by Hedgeye. Hedgeye does fantastic work, and I think that shines through in the conversation we have today. If you like the conversation and are interested in learning more, please check out Hedgeye at hedgeye.com. That's hedgeye.com. Hello and welcome to yet another Value Podcast. I'm your host, Andrew Walker. And if you like this podcast, it would mean a lot if you could follow, rate, subscribe, review wherever you're watching or listening to it. With me today, I'm happy to have Jay Van Sciver. Jay is the head of industrials and materials. If I remember correctly, you can't forget materials at Hedgeye. Jay, how's it going?
Great. Thank you so much for having me on, Andrew. I really appreciate it.
Hey, I really appreciate you coming on. Let me start this podcast the way I do it with every podcast. Quick disclaimer to remind everyone that nothing on this podcast is investing advice. That's always true. But Jay, I listened to a prior interview of yours and I loved how you framed industrials. Industrials is the catch-all for things that don't fit in any other sector. But because you're the head of industrials and it's the catch-all for things that don't fit elsewhere, we could go into a lot of different places in today's podcast. So people should just remember, we're just talking. Nothing here is investing advice. Please do your own work and, consult a financial advisor. Jay, I think you thought we were recording before we started. We weren't recording, but we were having a really interesting conversation about Tesla, which we're recording this on Wednesday afternoon, April 19th. They report earnings after the close. So who knows, maybe the stock's up 50%, maybe it's a zero tomorrow. No one knows. So we don't know what the earnings are, but we're having a really interesting conversation about Tesla and then Volkswagen, Porsche, kind of a little bit of how Volkswagen compares to Tesla and a little bit of the stub trade Volkswagen versus Porsche. So I've rambled a lot. I just want to let listeners kind of tune into what we were talking about before we press record.
Yes. And I think from a value perspective, the industrial sector is one of the best places to look because the earnings tend to be so volatile. Something like truckload carriers, over the next quarter or two are going to see earnings drop so much. You'll see people panic. The stocks will go down. The multiple will expand. They'll look expensive. But if you actually do valuation, if you actually are in the weeds, you can get wonderful value opportunities in the sector. And on the short side, you get some of the dumbest stuff that goes on, like truckload carriers with collapsing earnings currently being pretty near all-time highs, the United Swifts of the world. So we were talking about VW and Tesla, and I think it's an interesting, I would hesitate to call it a pair, although we certainly on our best ideas list have it structured that way, where we have long VW, which trades, as you were alluding to, for less than its public, large cap, liquid subsidiary trades for its stake in that subsidiary. So VW floated 25% of Porsche. It's not even a voting controlling stake that trades, and that values Porsche at more than all of VW trades for, which owns 75%. So its stake is worth more than what VW itself trades for. And it owns such trivial brands as Audi and Bentley and Lamborghini and VW itself, Skoda. It also has a finance subsidiary with I think it's a 30 or 40 billion euro book value. And Porsche is only like 11% of revenue. So it's a tiny part of total VW that's worth more than the rest of it combined. And I think that's interesting. I like things like that.
I do too. There are a few out there in the stock market. I mean, I've had a couple people come to me with the VW Porsche trade. I have not put it on, but it's better than all those because a lot of them, like, you have real hair at the holdco. The former Valiant now trades under I think it's Bosch Health, and they spun out BLCO, and their BLCO stake is worth like 2 times as much as their market cap is, but like the holdco has so many issues and there might be negative value there. Whereas with VW, it's like, there's clearly so much value. I've had people pitch it to me before though. And my first thought is always like, haven't people blown up on a Volkswagen Porsche stubco trade pretty famously? Hasn't that happened before? I think that might be one of the reasons the kind of setup exists like that. But
no, there are, there's hair on everything that's going to end up reasonably valued, at least a year ago in this market. And you have, one thing I think that's interesting about it as an event or an anomaly in the market is that the management team is actually distributing real cash to investors, right?
Yep.
19 euro a share dividend, and they actually could sell another 25% of Porsche and maintain control of it and distribute another 19. And then there's just within the VW universe itself, the discount that VW preferred non-voting has to the common is ridiculous. Your vote doesn't matter. It doesn't. You can vote all you want as a common shareholder. Porsche SE controls VW, which is totally unrelated. Well, it's not unrelated, but it's a different entity from Porsche AG. So I think there's like a complexity to the preferred common, Porsche AG, Porsche SE, VW. But just even that preferred common, as a former person who sat on a prop desk, like I love that kind of a trade. When that spread blows out, you put it on. When it narrows back in, you take it off. Used to be able to do that with lots of AB shares. Heiko being one of my favorite.
So Volkswagen, and I've seen the deck. I know this way. So you've got the Volkswagen prefers, which trades at a discount to the common, and then both trade at a discount to just the value of their Porsche. Do you like those as the stub trade or like kind of the hedge trade, or do you think the discount is just so wide? If somebody's going out, and obviously, look, again, we gave the disclaimer up front, shorting, doing stub codes, they have risk. We were laughing because people blew up on this in 2008, but do you think the value is there where you could just kind of go long Volkswagen and just generate alpha that way as well?
I think so. I could be wrong. We're not allowed to trade personally the stocks that we cover for research, but I would. That's totally the type of thing I would buy. But I probably have a value bias as an investor to my detriment in say 2020, 2021. But whatever. I think that kind of thing makes economic sense, and if you're driving market efficiency, you should be really doing that kind of thing. There are other pairs you can put against it. So we've had Lucid, which is an electric vehicle maker that's trying to compete in a market that basically doesn't exist. The ultra luxury, it's a tiny TAM, highly competitive market. You compare that against it. You compare Tesla, which was the other name we're talking about that's going to report today, which is basically a single product company, right? It is a company that's a 3Y that makes up 90% of revenue. They have an inventory build problem. They're cutting price repeatedly, and inventories as of the first quarter are still building. The CEO, if you want to talk about corporate governance problems, the CEO, this is Googleable, which is amazing to me, is that, everybody in Tesla should realize that Elon Musk got paid $23.4 billion in 2021. It doesn't show up on the income statement because his options got marked at 2018. And for the most part, options marking, grant date valuation, doesn't matter very much. But it's the difference between I think $900 million expense at Tesla and a $23.4 billion expense at Tesla. So when you think about how much of the theoretical profit that Musk has extracted from Tesla, it's much more than anything they've earned or will earn for several years. And then he left to run Twitter anyway. So what do you? Yeah,
I was going to say on the corporate governance, and stock options obviously matter, and you need to adjust for that. But it doesn't bother me that Elon gets the largest pay package in human history, and it's all options based, and the stock goes up 10x. And maybe you and I both probably think the valuation's crazy and all this sort of stuff, but that doesn't bother me. But what bothers me is they paid, as they said, the options are worth 23 billion. The dude owns so much, and you're paying that because allegedly you think he is the most talented entrepreneur in the world, and you need to pay him this so that he only focuses on Tesla. And then, as you said, he goes on this quixotic quest to buy Twitter. I think that's really hurt the Tesla brand, as we can talk about in a second. But then even more than that, just in the past week, he's launching this new OpenAI competitor, and he's doing it, he's doing the startup and funding it himself outside of Tesla. Tesla's paying him to be the highest paid, best entrepreneur in the world. Tesla is allegedly an AI company, right? What do they always pitch? Hey, we're going to crack full self-driving because we've got all this great data. We build our own chips. We've got this AI. And he goes and builds an AI competitor, which, AI could be worth trillions of dollars. He builds it outside of Tesla, ignoring all the other, the family members on the board, the solar state, all that. It's bonkers to me. It's absolutely bonkers.
Well, people who own this must have never really watched any other companies with corporate governance issues. Corporate governance is an important topic that everyone should look at the composition of the board of companies that they are invested in, because it turns out it's super important over time, and things get very out of control, and you really don't know that much about what happens day to day inside an office, inside a culture, inside the CFO's office with reporting and accounting. And to be honest, you should also care about the 23.4 billion, because in theory, you are sharing in these profits, and we're all pretending that there are profits there, and there are no profits if you adjust correctly for what he got paid. And it's not even close. So, you have a CEO with a corporate governance issue that's extracting all of the economic value from an entity and pretending as though it's cool and we're so happy to have him. That's completely wrong. Nobody else does that. It's insane. And the other thing I would say about the brand, yeah, Musk has clearly pivoted to the right politically. He's politicized himself. My opinion, and we've written this, so I will say something controversial here. It's an opinion, is that Musk is politicizing himself because he's at risk of being prosecuted for securities fraud for faking, for example, the Paint It Black video, where he presented a product, faked the video, presented it as a real product, and then sold a lot of stock, billions of dollars in stock. Usually, I don't know about what stock market you've covered in recent years, but my understanding of the stock market is that if you fake a product or lie and then sell stock, it's kind of a big deal.
You know, I followed the SPACs really closely in 2020 and 2021, so that was kind of par for the course for a while. But
it became normal. But it became normal in part because this like Silicon Valley, it's not normal. It's wrong, and you shouldn't do it. And it's bad for capitalism and wealth creation in the United States. And it somehow has become normal in a way that is not normal. And Musk is in many ways at the center of that. Like, oh, you know, I'm rich. I can open my facilities against public health orders. And what are you going to do about it? I can flout dealer laws and just open stores. What are you going to do? Sue me? And if you sue him, he's super rich and he'll tie you up in court. But there were reports that the DOJ was investigating him, and suddenly he becomes a right-wing guy who's tweeting that Taiwan should go back to China. When you're just like, what? Like, where did that come from? I thought we were all fighting global warming and saving the planet, and now he had a whole investor day where climate change didn't even come up. But I think that's one thing that's hit the brand. But we do pretty detailed surveys regularly since 2018 on the EV market and landscape, and the Tesla brand has taken a hit. I think that the bigger issue is that people can see competing vehicles for the first time that are attractive. Like if you go back to 2019. There were basically no EVs that you or I would be like, oh, I'm so excited to buy that car. I mean, the best one was the Jaguar I-Pace, which didn't have a lot of range, was the Jaguar. So you know it's going to be broken a lot or whatever, right? So, you could buy the Bolt, which was ridiculous. You could buy the Leaf, which was, these are like second cars for going to the grocery store. These aren't like primary vehicles. But now you can buy a Taycan, an e-tron, a Rivian, a Lucid. You can buy really attractive, and forgetting to get into the Kias and the Hyundai, and you finally have Toyota introducing a battery electric vehicle. So the amount of options that you have in the electric vehicles with the F-150, you have all of these new electric vehicles, Mach-E. I mean, we make a list of it, and we gave up on the list because there's now so many alternative. The best one I've driven, I actually thought the Volvo little electric SUV is a really nice car to drive. There's just so many of them that it's just less differentiated than it was.
And now a quick word from our sponsor. This podcast is sponsored by Hedgeye. Hedgeye does fantastic work, and I think that shines through in the conversation we have today. If you like the conversation and are interested in learning more, please check out Hedgeye at hedgeye.com. That's hedgeye.com. Let me pause you there. I want to ask 3 questions. So first, unfortunately, most people listen to this audio, not video, so I try not to share slides, but I have seen your slides. People can go find them somewhere if they want. Your slide on it is percent of people surveyed that would buy Tesla over another EV brand. And if I'm just looking at it, you guys started in 2018 and up until May 2022, Tesla kind of always pulls in the 70 to 80% range. So that's huge, right? Basically, everyone is saying, I'd rather Tesla over everyone else. February to May drops from 70% to 56%. By far the largest drop. You've got the first time that they kind of don't round out to 70%. And then December, they're still in that 56% range. December to February, so that's the most recent one that I've seen you guys publish, they dropped from 56 to 40%. So I was just wondering, is there, obviously the competition's coming online, but is there anything else like the May 2022? It does strike me that's right when we start buying Twitter, but is there anything else that you can think of that's driving these two? I mean, these are massive drops inside of a month, right? And obviously the February one is one data point, but from the February to May one, they consistently go from 70 to 56%, and they're there for the rest of the year. Like, is there anything else in particular you're thinking is driving this?
I think there's 3 things. First, people on the political left buy electric vehicles. People on the political right may buy them, but just statistically, they don't buy them. So if you liked the Twitter files or whatever, odds are you are on the right and believe in the free speech and government shouldn't email a social media platform to take down Hunter Biden non-consensual nudity videos, right? Like that's probably your bias. And if you're on the left, like you see Musk being, I mean, he's tweeted that it's nothing new about him. He's tweeted a variety of things that would get me sent to the HR department, and he's the CEO of a company. You find some of his things about like Fauci's pronouns. My pronouns are prosecute and Fauci, which isn't actually how pronouns work, and you can make some very funny sentences out of it. So I think he turned off a lot of the traditional buyer base for his electric vehicles and basically moved his personal brand to a cohort of people that don't buy electric vehicles in the way and haven't traditionally worried about climate change in the same way or their environmental impact in the same way. And then they're like, oh, he's just preparing them for the truck. And I'm like, I don't think they're going to buy that truck. Like that isn't the truck that, a guy who's, wants to put MAGA flags on his truck is going to run around in. I mean, I think they'd make fun of him. But that's my, take on it. But I think the bigger issue is that supply chain difficulties were a massive headwind to the launch of the EVs in 2021. So 2021 was initially going to be a very big year for new EV introductions. If you think about Tesla and their success, the Model 3 pre-sold very successfully in 2016. So the major OEMs were like, oh, batteries are here. Let's start developing these battery vehicles. It takes 5-6 years to develop a new vehicle. So you had a whole slew of the first barrage of new launches really scheduled for late 2020, early 2021. And they all got demolished by the pandemic. And when supply chain difficulties eased, a lot of those Super Bowl ads and new introductions came out in really, you can look at supplier delivery times or any of the indices for, supply chain stress, or just even the shipping rates for parts from China and stuff like that. They all came down in the second half of 2022. So you start to see the, supply constraints on competing vehicles come off at that time, coincident with the issues around Musk's personal brand within that community. And, the other thing is, I think that another really important thing is just that these are aging platforms. Like the Model 3 and Y is now, they got like taxi cabs, the blue weird taxi cabs driving around with you want to drive the same car as the taxi guy, and when you have something like 2019, a whole bunch of cars get sold, they all look new and great. Now they're going to get dirty and scratched up. People are going to be driving around with dents in them, mirrors hanging off, just because that happens. Like, the Camry comes out and it's like, oh, it's a new Camry. It's so interesting. And then, they look beat up. And I see it the most like Corvettes. Like a new Corvette comes out, I'm always like, wow, that's really, like the current Corvette looks really good. But I know in 3 years it's going to look less good to me. So I think that's the other thing is you just have a single product company. It's like Peloton. They make one thing. And that's like, I have a Peloton treadmill. So they don't make one thing. And the treadmill was excellent. And if you still have the recalled one, you should try and sell it in the second market because people really want them. But
I remember when the recall came out and you could go onto like a Peloton message board and there'd literally be, mother of two, 45-year-old woman, she'd be like, they can come take my Peloton treadmill for over my cold dead body. And I was like, wow, that is some intensity around the treadmill.
It's a really good treadmill. And the terms on which they sold it to you I have one and it's amazing. It's a really good treadmill, but if something does get stuck under it, it is remarkable how quickly we had a thing get stuck under it, and the whole treadmill was up on its corner, and it weighs like 400 pounds, so it could be really bad. But I think you have the same vulnerability where you have a single product or a single product category, sort of the 3Y, that is entirely dependent on the success of the company. And that is, under assault. Like you can buy this new Kia EV6 and it's a good looking car. You can buy the Volvo, you can buy a Mach-E, you can buy a whole ton of cars. And you don't have to feel like you're driving around in a MAGA mobile that all your friends are going to judge you for if you live in the, Northeast corridor of California.
Let me ask you another question. Just Tesla. Especially shorts, underweights, that type of stuff. Like the question is always, why now? Because the conversation we're having, I do think the brand is worse today. I do think there is more competition, but you and I, a lot of this conversation we probably could have had back in March 2018. Like I specifically remember being short Tesla at the time, and the stock, I think it was March 2018, went on a crazy run. And then, a year later, Elon's giving interviews that said we were a week or two away from bankruptcy at Tesla. And I was like, oh my God, I knew it. And somehow he pulled a rabbit out there. And I think like no stock has burnt short sellers like Tesla has, excluding maybe like some of the really memey stocks. But over the past 10 years, no stock has burnt Tesla. And every time you think it's done, like I remember coming into this year, I was like, I feel like the Tesla brand's getting hurt. Competition is coming. The stock's up with like 40% this year, not to results based or say a very short time frame, but just every time you think this company is done, Elon pulls a rabbit out of their hats. Or I remember one person said once, I think it was Dan McMurtry, hey, the bear case for Tesla is competition is coming and they're an overvalued car company. And the bull case is Elon's going to take us to Mars. Like, how do you fight that bull case? I don't know, just like why is now the right time?
Well, right now they have an inventory problem and they're cutting price desperately. And if you saw that at any other consumer product company, you would get, I can't get a locate fast enough.
Two price cuts in 4 months in an inflationary environment, and just the whole market doesn't care.
And the inventories are still building. Like in the first quarter, you had another increase in inventory when that is not the auto market. The auto market is still in deficit, right? There's still some supply chain issues. The whole dealer channel is hollowed out. And I know there are conspiracy theories that say that isn't true. It's all off lot. I'm like, just look at Manheim, right? Manheim is still up. There's not enough cars. And that's, or go try to buy a car. Like I love to go buy cars. Took my son to the Bentley Lamborghini dealer, got this cute picture 7, driving a Lambo, right? Not really driving it, just in the car, but that's what it's like.
Breaking the law and running into stuff.
If my kid could drive a Lambo, like I'll pay the fines and do the time. I'd be so proud of him. All my kids can drive. Well, my two oldest kids who can reach the pedal can drive a manual, but we do it in a driveway, just to be clear. The point is though that I don't remember the point of that.
I think I was asking really why now on Tesla. That's kind of what we were talking about.
What was that?
We were talking about why now on Tesla.
Oh, why now?
And you were saying, look, we talked about the price cuts, inventory building, and I think that's kind of, yeah.
So like if this were any other any shoe company, retailer, any other durable consumer product company that had, they're literally adding 2 factories and they're having a problem. They're adding, Texas and Germany. And they're already having a problem selling their current production and cutting price with inventories. Even in the first quarter, inventories went up. At a time no one else is having that problem. We're entering a recessionary, we think, from a macro environment. Clearly, borrowing rates for something like a car are higher. And he just trained everyone to sit around and wait for price cuts. I think it's like a total mess. And there were not competing vehicles. There were supposed to be. They didn't show up because of supply chain difficulties. It was, in a way, a very weird bailout. And the most important thing is, as somebody on Twitter responded to me, when we post this chart of like Tesla relative to the market versus Fed funds. When the Fed, is accommodated and liquidity is abundant and a bunch of people who aren't sophisticated investors come in with their ape into AMC or SPACs or any of these bubbles that came up. And I think that hopefully, since this is a value investing podcast, every single person on the other end of this understands exactly what I mean. The tide is going out. The Fed is tightening. SPACs have already blown up. Lucid is, blowing up. All of the autonomous stuff blew up, right? Some of the stuff that's blown up is actually going to be, I think, interesting in the long run. And Tesla's actually down 50% in addition over the last year, in addition to up 50% year to date, which tells you everything you need to know about. We call it the last garbage standing. And, we can look at Musk's AI thing, and I called him a jack of all bubbles, right? Like if streaming companies are coming public, he's going to have Tesla streaming. If autonomy is what's hot, he's going to do full self-driving. If it's electric vehicles, new energy, whatever it is, like he tends to be on it. That's just how he is. We're going to mine lithium with table salt, right? How did he get out of the 2019 situation? I think it's very obvious that he held Autonomy Day, where he told of everyone he was going to do a variety of things that 4 years later didn't happen. And he probably knew at the time weren't going to happen. and he sold stock because Tesla's primary product, the thing they are the best at selling, is stock. And you can be like, oh, they haven't sold stock to the public. It's like, no, they disrupted that by giving it to the CEO, who then in turn sold it, right? The main product there is shares of stock, in addition to the Model 3, which is a very nice car. I don't think the Model Y is nearly as good. And they did a good job with the Model 3. So I don't mean to take away from that, but the Peloton is also a really nice treadmill. I'm a huge advocate for that treadmill, even though I'm sure it will kill me one day. So being a nice product doesn't get you that far in stock market valuation and durability of products.
Let me go back. We were talking Porsche VW, and I think a basic question to ask. So you've got this trade where VW is trading for less than just the value of their Porsche shares. That's a pretty obvious arb. I haven't looked at the bar or anything, and again, short selling is risky. Everybody, I'm assuming Porsche would be a little bit difficult to borrow since VW owns 75%. But even there, like buying the rest of VW, you mentioned the financing arm, all their other brands, like that's obviously a good trade if you can get it for more than free. I guess just the first question I should have asked is, why does that trade exist? Like, what are you and I seeing here that the market's missing? Is it just Porsche's low float, so nobody can short it and hedge this out, and Porsche's actually just massively overvalued because a few retail guys who love Porsche are buying the stock? Or is there something else going on there that's kind of presenting this opportunity?
Yes to all of that. Porsche is not without hair. I mean, it is, they have, first, it's a European industrial. And usually my thought on European industrial, specifically French industrials, is nobody ever made money there. Right? No, just don't. Whatever it is, leave it. It looks good. But Germany and Sweden, you can occasionally do okay, right? So we'll take that more seriously. But you do have, for example, labor on the board. You have more of a stakeholder culture in Europe. You have the Porsche family is in a controlling stake. You get into a lot of the politics between the government of Lower Saxony as a board seat and some influence. So you have this weird governance. It's not necessarily evil or fraudulent, but it's not great because you just had all this Dieselgate stuff that went on that was definitely operated at the. So you have some history of bad governance of that sort of toxic brew at the board level, not being great for value creation and shareholders. Although I think Dieselgate was an effort to maximize shareholder value by a fraud, but whatever.
You don't hear that too much, right? Maximize shareholder value via fraud. That's a rare sense.
Kind of where we're going, right? They want to sell more cars. They want to win it. And, a little bit they get away with that because it's the sort of national champion. Who's really regulating you? Oh, you're friends of the German government, right? And you're probably one of their largest taxpayers, employers and all that stuff, right? There's all kinds of conflicts. I mean, we talk about the investment industry conflicts of interest, but I mean, every industry has deep conflicts of interest. So I think there are issues with governance in the board. I think that board currently recognizes the low VW valuation is bad for VW's brand and the marks that are under its umbrella, and they want to correct that. I think they also initially not overcorrected, but they were also forced into being early into electric vehicles. So they're investing in Electrify America. They were selling EVs earlier than most other companies. Yep. And like I pointed out with Tesla, the way they were early is they were willing to accept a $7 billion loss in their first whatever number of years of operating. Everyone knew electric cars were coming. They just were willing to eat the loss early and build a franchise in it. And, to some extent, VW has done that as well. And I think there's a huge complexity issue. You start explaining that there's Porsche SE, which is owned by the Porsche family. And they are actually the controlling shareholder in VW via the voting VW shares. But there's also the VW preferred, which is non-voting and trades at a discount to the common, which is controlled by the Porsche SE family. And then one of the ways that VW created value was by IPOing Porsche AG, which at that moment, everyone's like, wait, there's two Porsches? And that also has a common and a preferred and trades for more than all of VW. And when you start explaining all that to even a sophisticated institutional investor, the term is brain damage. They don't want to do the work. And you can make money. I mean, Liberty, and there's been a variety of things where understanding something complex.
Can't make money in Liberty recently.
Oh, I know. I'm just saying, historically, you can make money in things that are complex or whatever. But, sometimes if you have 100 companies under coverage, or you're a PM who's trying to go across all the sectors,
Yep.
It's a lot easier to hear oh, they're going to Mars. long, right? Like that is definitely a dynamic that I think we've probably all seen play out in institutional investors. But inefficiency, a management team that's actually, I mean, they're talking about IPOing Lamborghini, right? Sell 49% of Lamborghini, pay out the whatever, $8 billion or whatever that raises, and give it to shareholders. That is just like a very natural way to get rid of, the stock won't go up, but your total return sure will.
Yep.
And that's a very natural way to correct the valuation disparity. So, I think that is a trade I like a lot. It's worked out in the last year. And I think it is, if you are, worth your salt as a value investor, and VW has some like really even beyond Dieselgate. There's a lot of like, I mean, they behaved badly during World War II. We were going to title. Oh yeah, you just can't. There's baggage in history in any old industrial company, right? Like it's just how it is.
Let me switch gears completely and ask you about, I think, unless you've changed your recommendation in the past couple of days, bearish Uber is one of the positions you guys have. And
yes,
it's just one that's interesting to me because I've got a lot of friends who are long it. I've got a lot of friends who wouldn't touch it with a 10-foot pole. I think the long thesis is you've got the leader in mobility. It seems that Lyft is imploding as we speak. I'm not sure how long that's going to be like a 2-player market. It seems like it's going to 1-player market. You're getting glowing profiles in the Wall Street Journal of Uber CEO spending 2 full days being an Uber driver and being able to fix all their driver problems because of that, I guess. But I just want to ask you, bearish Uber, obviously a little bit of controversial stock. What's making you bearish there?
So we did the IPO as a short. And we still have that on from that period. If Lyft goes away, that would be interesting as a structural change to the industry. But the reason we are bearish Uber, and this is a great, actually, I love speaking to, I speak to too many non-value investors, but I assume everyone on this call is familiar with like Michael Porter and industry structure, and that there are good businesses and bad businesses. And Uber is obviously like structurally in a difficult position, right? They're just when you do it out, the cost of having a chauffeur is just really high. Like the cheapest way to get around New York, you and I are both in New York, is to run or take a bike. You will take the least time and it will cost you the least. That's why City Bike is very successful. Owning your own car outside of New York, a place where parking is a pain, right? Anywhere outside of high parking costs, it makes more sense to drive yourself. It takes less time. The bus is a disaster because of the amount of time it takes. We put like $100 an hour on people's time. People overvalue their time. You can tell that by who takes the Acela versus the regional on Amtrak and things like that. It's like your time isn't worth that much probably, but people put a high premium on it. And the problem with Uber is just that it's really expensive to hire a chauffeur. The real problem with Uber, the thing that we came away with like very confident on saying like this is an IPO you can short, is that there is the theoretical industry structure advantage is supposed to be a network effect. That when more people show up, more drivers show up, and more drivers show up, and you get this wonderful people all in the network. Well, the problem with that is that one, people can just get on 2 networks at the same time. They can get on Lyft and Uber at the same time. And second, there are tests for network effects, which is that, daily average users over monthly average users over time. Like, are people using the product more? Like, I log into Facebook once a week, but then I find I love it. I'm on. The more time goes by, the more users are there, the more interaction you have with it. Well, Uber failed all of the network effect tests. It doesn't have one, which is why it's so big and still loses money. No matter how they try to define EBITDA and all of these numbers, we're going to be adjusted, remote, recalculated, excluding everything EBITDA positive, right? You hear, anyway. So I think the problem with the business is that they have historically lacked a network effect because there are some significant structural problems. We do it out. It's actually we use it still as an industry structure example of a failed industry structure. But one of the problems is just that the switching costs for drivers and riders is very low. There are lots of alternative transportation mechanisms, so it's very hard to get that network effect to work.
No, I think that's the big thing because I do wonder, like as you said, the switching costs for drivers and riders are pretty low, but everyone else is imploded. So it does seem you're going to a place where Uber is kind of the only place for riders and drivers to go at that point. But it's just the everything else, right? Like every time I go out to dinner on a Friday night, it's 9 o'clock. I'm 50 blocks from my apartment. I pull up Uber and I see, oh, if it's $10, I'll probably bite the bullet and pay a little extra, take Uber, but it's 15 or 20. Great. I'll spend an extra 10 minutes and take 250 to take the subway and the bus, or I'll do I am a huge city bike fan. I'll probably city bike by your apartment later today, but and obviously subway and bus and city bikes versus Uber is a New York City thing. I don't want to be like, but if you're in the suburbs, you've almost certainly got a car. So you weigh, hey, do I want to go out, have a couple drinks? I'll take an Uber then, or I can just drive. Like it's just, there's so many alternatives. It's just really hard when it's not just that people can go to your competitor. It's that you're always weighing every other alternative against it. That is just a tough slog.
It really makes the most economic sense outside of areas where it's impossible to park when you're going to the airport, because the airport parking is expensive.
Yeah.
Outside of basically every other use case besides dense urban areas where you can't park and airports, it doesn't make a lot of economic sense. And there was already a competitor in the form of taxis and black cars and limos that met the needs of people there. They elbowed them out to get into that incredibly desirable, lucrative market of running a taxi service. You're just like, okay, great. Like, and
before Uber, it was pretty lucrative. I mean, you remember all the stories about taxi medallions. In college, I remember I went to a conference and a private equity guy was in Dallas, and he talked about owning the monopoly in the Dallas market and how much money it made. And I thought he was kind of arrogant. So when Uber came around, I was like, I bet that guy's regretting how much he talked about that in the past.
But they had a regulatory barrier to entry, and that was amazing. And now basically Uber blew up that. So yeah, I look at it, and if it were a monopoly, then yeah, I guess you would get you probably see the network effect of that, and they'd be able to take price. But yeah, I'm a huge user of Uber. I don't look at how much it costs, and as long as it's not stupid, like you got to get to the kids somewhere, so you're just going to get in the car, right? Although I greatly prefer taking a New York City cab when I can get it, because the drivers are better. Like they actually know what's going on. You get some guy who's just drove in for the day or whatever, driving around New York, and it's like, oh my God, why are you going there? We're gonna die. We're like in the tunnel or something. You're gonna die. You never get there.
The other day, my Uber driver missed my exit, which it was a very obvious exit. He missed it. And then right in front of us, there was a car accident. So that mixed exit, which should have cost us 5 minutes, ended up costing us an hour and a half because we were stuck on and it was a big accident, like 7 police cars, 2 ambulances, a fire truck respond. I was like, oh my God, I cannot believe one exit is costing us. Anyway, the other thing with
business, it would have made money by now.
The other thing with Uber, like if you think about the alternatives, business trips, you go somewhere and I instantly just price out, hey, I need to make 4 trips. Is the cost and convenience of an Uber going to be worth it versus renting a car, being able to instantly leave, go wherever I want, maybe take a couple extra, like there's just so many alternatives to it. It's very tough. We've been going for about 45 minutes. I think we've got another 10 or 15 minutes. I've got lists of everything that you're long, but anything else you want to talk about with kind of more of a value investor focused podcast?
I do think, well, I mean, so one of the things we've been working on the most recently is the truckload carriers.
I had your short, I think your short truckload carriers and your long rails. I thought that was a pretty interesting.
Yeah. So, I mean, rails are, speaking of regulated quasi monopolies, the cycle. So one thing we do, I should probably have explained our process, but our process is usually to define the cycle in an industry, like what actually drives the cycle. And for a lot of industries I cover that are, physical fleets like trucks or construction equipment, what drives the cycle is actually replacement demand. That you'll have a cohort of, it's like demographics, we call it fleet demographics, right? Where you have a cohort of equipment that gets, old and has to be replaced. So the best example of that is rail cars, because there's a regulatory restriction on interchanging rail cars that are older than 50 years old. So if there's a huge number of rail cars that are going to turn 50, that they're going to sell replacements for those. And if they're not, And then people are like, well, they never last that long. It's like, no, actually, there are like 80-year-old rail cars still running around that don't interchange. So they just like ship lumber, inland or whatever. So that's, and we did Wobtech as a short because the fleet demographics were turning very bearish and you weren't going to have any replacement demand for a while because in 1974, they changed the life of a rail car from 40 to 50 years. So you ended up with a 10-year gap in replacement demand, which was a really good trade that will reverse. We usually use shipbuilding, which is after World War II, you had a whole cohort of ships come into the commercial fleet. Ships last for 30 years. You had a peak in 2011 was the last peak. And, people don't talk about Baltic Dry all the time and dry bulk shipping the way they did back then. So, but they aren't all fleet demographics, right? A lot of the drivers are regulatory. So for Class 8s, it was always emissions regulations. It's now no longer emissions regulations. They've given up on that. But now it's just fuel economy, which is like what they were doing anyway. But one that's really interesting is rails, where railroads were a lousy industry for a long time because you had the Interstate Commerce Commission regulating pricing. So a shipper would go and take a rate case, they complain, and structurally the rails just couldn't fight that pricing, and they ended up taking, and they had all these other burdens that were forced on them. They had to take passengers, all this crap. So for a long time, the 50s, 60s, 70s, rails were a lousy industry to be an investor in, deeply cyclical, subject to marginal freight demand. And then you get deregulation. Jimmy Carter, the great deregulator, is how he should be remembered in my space. Trucking, airlines, rails. You get eventually to the Surface Transportation Board and the composition we have now, and you have a very light touch on rail pricing. And when you think about the lobbying power of the rails, right, it's super consolidated. There are basically 5 Class 1s. And there are employees in basically every congressional jurisdiction for the rails. It's like the Defense Department, defense contractors. They wield an enormous lobby. And that's the road they've taken. I don't know why they're being like so stupid on the PR front recently with respect to the accident in Ohio. I mean, nobody dies in rail accidents. It's a very safe industry. People die in rail accidents when their car gets hit at a rail crossing. Rails are a very, very safe way to move a huge amount of freight. Nobody even died in Palestine, Ohio, right? Nobody was even hospitalized, but we somehow have made a national emergency out of it. But the reality is that they have this enormous pricing advantage. If you want to get your coal to the power plant, you're going to pay your railroad. They take price every year. Margins go up every year because they are a lightly regulated monopoly. Now, eventually, it will be too much, and the shippers will get together and oppose it and bribe politicians to re-regulate the rails. And that could be in like 2060. Like, I have no idea when that's going to happen. It certainly isn't going to happen right now. So in the meantime, these are like basically lightly regulated utilities with, in terms of their sort of factor characteristics in the market. And the other thing that really matters for rails is how fast freight moves. So if you can move the same amount of freight in half the time, you get to book that revenue earlier. So the congestion we saw from COVID, right? You heard probably about the ships backed up at ports and trucks backed up at rail yards and ports, right? It just snarled the whole transportation network in the US. People were out sick. The freight lanes changed, like everything went wrong. And it's a very sensitive network. You'll think of it not like a sensitive soul, but like if you get a disruption to a trade network, suddenly you have a train in the way, and you have a train in the way, just like your traffic accident, right? You get stuck. You get backed up, it all kind of compounds. So the decongestion, the speeding back up of transportation networks in the US frees up capacity. Freeing up capacity is bad for truckload carriers. Freeing up capacity is fantastic for rails, because the thing I think people also don't know about the railroads haven't grown revenue ton miles capacity, how much they move, in 2 decades. They are not growing capacity. It is exactly like a flat line from 2004. It's not a volume story, but margins go up because it's a pricing and cost story.
I guess just looking at the rails. So I've just pulled up Norfolk Southern on Bloomberg. I haven't done a deep dive into these in a while, but I guess the pushback on it would be, I'm looking at 2023, 2024 estimates, and it trades for about 15 times price earnings, right? It's about roughly right. I think you laid out a coherent story for volumes going up, margins, but like if I'm buying a rail, this leapy growth company that's just kind of relying on margins and pricing going up a little bit at 15 times, like, are you really going to generate alpha at that multiple?
Yeah, I mean, I think you are. Like the rails for the margins for class one rails were like 12% in 2007, and they're like 30% now. So these aren't that sleepy. They take a lot of price. And their costs are coming down quite a bit over time as they kind of optimized a fixed network and increased. Yeah, they use more technology. There are some big cost reductions they could make that will probably be harder to do in the wake of more regulatory scrutiny. But I mean, these aren't like, this is a straight line up from deregulation. So you get the STB in 2006. And just, you're talking about more than doubling margins in a decade and a half, or a decade, really just a decade, doubling margins in a decade. That's pretty good. So I think there's no reason to expect that won't continue. And then you get people they're like, well, they only earned X in 2019, which you can be like, oh, well, that's an industrial recession. And 4 years ago, 4 years of price increases.
Yep.
Inflation hit them kind of, there's another like inflation aspect. Like inflation was bad for them because they typically price out. It's a mix of contracts, but the average like big shipper will price out a year. So they know and there's some longer term ones too, but they'll know what their prices are going to increase. And if suddenly their costs increase more than that, that's ex fuel surcharges, right? That's kind of a negative. So to the extent that you get disinflation and ongoing pricing, and the network speeds up, which lowers unit costs, I think it could be a really good group to be long. Is it going to light your portfolio on fire? No.
You got to be careful talking about railroads lighting stuff on fire on the heels of an accident, Jay. Come on.
Yes, no, lighting it on fire was the right thing to do. So I'm a chemist. I have a degree in chemistry. I worked in a lab, and I left chemistry to join the buy side at Brown Brothers Harriman, which was quite a career change. But I know a lot about chemistry, and I've covered the rails for 2 decades. And this accident happens, and I'm like, this is my moment. I've been training for this my whole life. It was actually, I think, a huge regulatory victory, right? There was an accident. It was immediately disclosed. People objected to the process of remediating it, right? They objected to lighting the vinyl chloride on fire. And I'm not saying that lighting vinyl chloride on fire is something you want around you, but they evacuated the area. They are, removing contaminated storage. Lighting it on fire is probably the best thing you can do to get rid of it, right? What do you think happens at a hazardous materials waste facility? They light the stuff on fire. That's What happens. You burn it. There's no other way to get rid of the stuff. It just looks ugly, and it does create an acidic ash, which is not great. I don't mean to minimize that it's not great, but nobody killed, nobody hurt. Everyone's like, the press isn't covering it, as I see it on every television screen at the gym.
It was on
crazy.
Every late night show was covering it. It's great. Just a quick question. Norfolk Southern down about, let's call it 20% to make the math even this year, whereas I think a lot of the other rail peers are up. Do you think, I'm guessing this accident has a lot to do with that. Is there opportunity in Norfolk Southern right now?
We have it as a long, but I think they'll all work. They're all correlated. I would prefer Norfolk Southern because I think the rail accident is way overblown.
That was more what I was asking. Yeah,
But I think you can own a basket of them. I don't think you have to, take the individual risk because, the reality is it's a good business to be in, and it will make money even if we have a bad recession.
And now, a quick word from our sponsor. This podcast is sponsored by Hedgeye. Hedgeye does fantastic work, and I think that shines through in the conversation we have today. If you like the conversation and are interested in learning more, please check out Hedgeye at hedgeye.com. That's hedgeye.com. Last question, and this is me being a bad podcast host. I prepared more on the industrial side, and I think you've got a longer industrials coverage. The interviews I saw with you had been more on industrials. But on the material side, are you following tech at all?
Tech Cominco or...
The tech Glencore crazy buyout offer, the spin that's happening. No, okay.
Wait, I'll just be like, I've looked at it. I mean, so we have a couple of interventions of substance on one thing that we cover what we cover, and we don't cover what we don't cover. I can talk about almost anything, but I've covered industrials a long time. You listen to the Glencore earnings call and they'll start talking about their fatalities. But it is, we have two things that we're really doing. One is short-based commodities. So CF and then urea fertilizer names, where there's a huge slug of capacity coming. Everyone wants to talk about high marginal gas prices in Europe. But what they should be looking at is India going self-sufficient, Nigeria moving to the export market, and the fact that global consumption of urea in developed markets in the US goes down. It actually is in decline, not over like some short period of time, over like decades. And globally, it's probably going to go into decline with China being more responsible with use application. And then short steel is, I think, one of the coolest places to be short. Very straightforward. What you had was very high shipping costs through 2021, 2022, which narrowed the competitive geography, right? So suddenly, if you wanted to build a toaster out of steel, you literally could not import steel. It just wasn't economically reasonable. So you get this.
I heard you describe it on a prior podcast. Steel is normally an international market, but because shipping costs went so high, it turned into like cement. It was a local market where, hey, if the steel was more than 50 miles away, 50 miles might be, but you basically couldn't get it. It turned into
it's exactly like, so that dynamic is since reversed. And then on the long side, we have, I'm a believer that electric vehicles take share because everyone's already building the factories to make them and they've already designed them. And we survey consumers, they say they're interested in buying them. So I think when you do it out, there's absolutely no way that you're going to have 20% of auto sales that are electric in 2030 because you simply don't have the metal. Like you don't have enough lithium. It's like math. It's not even, I don't know why, like whoever wrote the IRA didn't do out all the math for hydrogen subsidies and all that stuff. Because when you do it out, you're going to end up with like no lithium and a negative hydrogen price. There's I know the market will adapt, but like you wouldn't have chosen those subsidy levels if you had really thought it through carefully through non-lobbyists. So I do think that Albemarle is like a normal company in many ways relative to a lot of materials companies. Like a U.S. listed board managed CEO in decent regions in which to produce good assets and is an interesting way to play what is likely to be another super cycle. Like we saw that with iron ore, where you had in 2001, I was in the materials analyst in 2001. So like people would come in and be like, can you imagine if everyone in China bought appliances, how much steel and iron ore that would consume? And it turned out that was right. That was like a really easy thesis. And I think, you do the same thing here. Like, can you imagine if a third of people bought electric cars, what that would do to lithium consumption? And you look around and you're like, wait, that's right. So I think that's one that we have as along where you are going to be in until you get to lithium recycling in a amount that matters or a cessation of EV demand growth. In a long upcycle in lithium consumption.
Perfect. Well, hey, Jay, this has been absolutely great. We'll have to have you on again, but we're approaching over an hour if you include our pre-podcast chat. So I think we have to wrap it up here. But where can people find you if they kind of want to learn more?
So if you're on the institutional side, you can email sales@hedgeye.com and we can get you set up. We have for non-institutional individuals who are interested, Industrials Pro, which is if you Google Hedgeye Industrials Pro, believe it or not, it will take you to the page where you can sign up for that. And those are our two main categories.
Cool. And I'll include a link to your Twitter account as well, so people can go follow you there. Very active Twitter profile over there. But Jay, really enjoyed having you on and looking forward to the next time.
Great. Thank you so much for having me. It was a pleasure.
A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.